Hi, I'm Chris Lioutas from PSK Private Wealth, here to give you another investment update. Well, markets have been in a state of flux for the better part of the last couple of years. This has been a much better start to the year than last year, and mainly because of certainty and clarity provided by central bankers and regulators. So last year was very much a story of inflation getting out of control very, very quickly, and of course central banks to react very aggressively to get rates significantly higher off a very low base. And we saw markets start to fret and investors start to get concerned around the pace of those rate hikes. And the size of them as well, in that they were outsized versus history. What we've got this year is investors getting comfortable with where rates are heading. And so we're in most jurisdictions now, the feeling and the thinking is that there's not many rate rises left, and rate rises have sort of peaked out. And that's to do with the fact that inflation has largely peaked in most jurisdictions and most countries. So if we get inflation starting to fall rather aggressively over the forward period, then central banks don't have to act much more aggressively from here. The key question for markets now is how long central banks stay at these levels in terms of high rates, and that'll really be a month by month, quarter by quarter look at inflation in terms of how quickly it falls, given most central banks target a set level of inflation. What that's providing is clarity and confidence to markets in terms of the forward outlook. So we're getting corporates providing better guidance, better outlooks. We're getting investors being much more comfortable with placing money in a variety of asset classes, just because of that clarity around where rates are heading and where inflation heading. There's still some issues to work through. I wouldn't say all of it's been resolved. So for us, in terms of our outlook, we're okay with the outlook. We're not overly optimistic. We're not overly pessimistic. Very much that balanced scorecard at this point in time. But we see both risks and opportunities ahead. We need to be cautious on the risks and then be ready to take advantage of opportunities as they present themselves. It's been an interesting 12 to 18 months on interest rate side in terms of where we've been and where we are now. So obviously central banks took rates to zero and in some jurisdictions negative through the COVID period to help and assist with the issues we saw there, and then got behind the curve when it comes to inflation. So inflation got very much out of control 12 months ago, and central banks had to react and act very aggressively. So we saw consecutive monthly increases of interest rates and outsized increases at that in terms of larger increments. And so we've seen that for the better part of the last 12 months, and what we're starting to see now is some of that come to fruition in terms of inflation. So inflation still very high, but has started to come down in most jurisdictions. So we think inflation has largely peaked. In saying that, most central banks target a set level of inflation, either a range or a number, and we're still well above those numbers in almost every country around the world. So there's still some work to be done, but we think a lot of the heavy lifting has been done already. What central banks will want to do from here is try and remain patient if they can, and that's around making sure that inflation continues to fall over the coming months and quarters. If it does so, then you could probably argue that rate hikes are largely done and behind us, but it may mean that they may need to keep rates at these sort of levels for a prolonged period of time. Time will tell, economic data will tell as to how patient they need to be, but at some point inflation will fall back down to those levels that they're targeting, in which case some rate cuts may be needed. And that'll really be dictated by the economic outlook. Most countries are forecasting a lower economic growth period for this year and next, which is to be expected given these high rates, but that data path and that economic path will be largely dictating where rates head in the next 12 to 18 months. For now though, most of the heavy lifting will be done. Obviously, it's been an interesting last couple of months when it comes to banks offshore, and we've seen a couple of US banks go under or be saved by the regulator, and then Credit Suisse in particular in Europe. And what's interesting around the banking issues offshore is that it's very different to the GFC. In the GFC, we had bad debts, and so we had loans being given to the wrong people or in the wrong amounts at the wrong period of time, and so we had a bad debt problem that went through the banking system. This time around though, we have no bad debts right now. So bad debts are at very, very low levels. And so what we have is really a crisis of confidence. So we have deposit holders taking money out of banks because they're concerned around the banks. And so that can be started by whispers, it can be started by a whole range of things. And so what we've had is central banks come to the party in terms of come and help and save these institutions in terms of either force them to merge with others or provide some comfort to deposit holders that these banks are being appropriately supervised and monitored. And so we've seen central banks provide liquidity to banks in terms of providing access to funding as and when needed, so banks don't have to stretch to pay or fund deposit holders. And so that's been a great corrective action in the short term. The difference this time around also is that we've seen central banks act swiftly. So in the past, you could argue they possibly didn't act swiftly enough. We have seen them act very swiftly to address these these issues and these concerns. So for now, we're comfortable with the banking outlook offshore. That's not to say there can't be stresses elsewhere, but it's definitely a very different predicament to what we saw in the GFC. Locally, banks looking in really good shape. Our banks here are a little bit different in that they're more exposed to the housing market than in most other jurisdictions. But because of that exposure and because of the lack of competition in Australian banks, the regulator here is significantly more stronger when it comes to supervision and monitoring. And so our banks here look in great shape in terms of their capital that they hold and in terms of the risks that are arising. For now, we remain comfortable with those risks locally, but also comfortable with the risks offshore as well in terms of central banks providing some comfort and some safety to the outlook for the banking system. Thanks for joining us today at PSK Private Wealth. I look forward to providing you with another update in due course.